Hi, it's Eng here, the CEO and founder of TMS Tax Accounting and Financial Services Firm. Welcome to my part 3 video on how to use your self-managed super funds to borrow to buy property. In this video, I'm going to show you the step-by-step how you can actually use your self-managed super funds to borrow to buy property. Okay, before I share with you the step-by-step how to do this, I'd like to give you that this is actually just a general advice disclaimer that the information provided during this video are of indicative nature only, and it's actually intended for educational purposes. So it has been prepared without taking into account your objectives, financial situations, or needs. Before you're acting on any advice, you should consider the appropriateness of the advice, having regard to your personal circumstances. So before making any decisions, you should seek professional advice from a licensed financial planner and a tax professional. And I would highly recommend you to get a personalized advice session should be undertaken before proceeding with any strategies outlined in this presentation. Okay, let me give you an example. Okay, so John and Jenny, what happened is that they love property and they like to build the properties in their portfolio. But because they have been borrowing a lot, so they actually comes to a point that the bank says no, like they can't lend them any more money. What happened is that they actually sold this property that is only, sell it for $400,000, and it's very good rental and good location as well. So they went to the bank, and then the bank say, no, because your credit is already up to the limit, we can't give you any more loan. So they're feeling very sad. So what can they do? Because they love to build, create wealth using property. So one of the solutions that they can do is they can actually use their self-managed super funds to borrow. So how does it work? Now, let me explain to you. Okay, so assuming John and Jenny is age 49, first of all, they have to set up their own self-managed super fund. Then both of them have some money in the retail super fund, like they probably have existing super funds in a lot of different funds. So what they can do is that altogether, two of them added up, they have 310,000. So they roll over from the existing super fund, retail super fund, into their own self-managed super fund. Then they're making a maximum concession contribution, which is 25,000 each, into their fund, and plus the employer will give them the 9% super fund as well. And what they can do is that they can actually use the money inside the self-managed super fund as a deposit, and they can borrow up to like St. George give like 72%. So they can borrow 72% from the bank and to buy this property. So how they buy is like, because self-managed super fund cannot borrow, so the house is actually have to buy under the Bear Trust arrangement. And I'm going to go in and explain to you step by step how this works in my next video. So they purchase and using the Bear Trust, and Bear Trust has to be a corporate trustee. Then they go to the bank and they borrow the money. The bank will use this property as a security, lend them the money, lend the super fund money, and so the super fund buy this property, but the bank has to lend them under what we call limited recourse loan. And what it means is like, say for example, if they actually buy this property for 400,000, and say if the self-managed super fund run out money and they could not make the loan repayment, which is not possible because they got quite a bit of money there because they're going to get the rent coming in as well. But just assuming that they can't, okay, and they're in default. So the bank actually have to force to sell this property, and say the property just went really bad and it can only sell for 300,000. And the borrows is 320,000. So even though they sell it for 300 and they still pay off the loan of they still owe, because they borrow 320,000 and then they only can sell for 300,000, so they still owe the bank 20,000. They can actually the self-managed super fund doesn't have to pay that 20,000 because it's limited recourse loan. They can just walk away, and that's why the bank normally, if you want to borrow money under self-managed super fund, they cannot give you the ratio is quite low, it's 70%, and maximum is 72%. And the self-managed super fund will get all the rent because they're going to rent out this house. And the self-managed super fund will pay for all the rent expense. So all the money will go into, you open up a bank account for self-managed super fund. So all the rent received will go in there, and then they pay for all the rent expense. All the contributions will go in there as well. So you have actually three sources of income. Like you got money, salary sacrifice from yourself, and then you have the 9% super from the employer plus the rent that received. All this money will actually help you to repay back the loan repayment back to the bank. And so when you pay off the loan, then the property will transfer to self-managed super fund. So the self-managed super fund will make the loan repayment, and when they pay off the loan, then the property will transfer to the self-managed super fund. And if you get all the paperwork right, then they will not have any capital gains tax or stamp duty. And I'm going to run through with you in my next video, which is part 4, step by step, to get the paperwork right. So just imagine that, okay, John and Jenny build up their portfolio, and they're 49. By the time they're age 60, which is 11 years later, and they just imagine they actually can buy, say, 10 properties inside a self-managed super fund, and assuming the growth rate is 7%, which is not at the moment. I know the property is pretty bad now, but just assuming, okay, that they actually can make 7% per annum, then by 10 years, then the house will double. So, just for one house, they can make like 841,000, and then just imagine if you actually have 10 houses. So you can actually build up a very good tax-free income inside your self-managed super fund by just using one strategy, which is, borrowing to buy property. And if you actually buy it right, which is now is actually quite a good time because property is quite low. But if you actually do make that capital gains, it's all tax-free. So it's a really good strategies that if you actually have the money in the super funds, then, it's really a good strategy to have to create your wealth. Okay, thank you for watching. Please continue to part 4. In my next video, I'm going to show you in a fraud chart, like step by step, or how the paperwork I put it together. So please watch my next part 4. It's how to use your self-managed funds to borrow to buy property by Eng Sibyang.